Hey there, and welcome back to the Above Board podcast. I'm grateful for you joining us each and every week. If you've listened to our show for a while, you know we talk about everything on this show. It's a documentation of our journey in life to progress, to learn from our failures, but it's also a great opportunity to learn from others like Mitch Matthews, who was on our show last week, where he talked about one place well. But sometimes we also like to talk about the thing we spend our 10,000 hours on, which is financial planning. Last week, Matthew Marcoux, Michael Scott, and myself provided a market and economic update for our clients. It was actually so positively received that a client mentioned I should share this on our podcast. Now, if you want to listen to the whole thing, feel free to head over to our YouTube channel at CandorPath and check it out. But today's episode is an excerpt where we look ahead for 2025 and discuss the financial markets and the economy. There are so many factors that will impact our economy in the coming years, and it's my hope that today's podcast helps keep you informed on those topics. Things like tariffs and tax law changes, the federal deficit, or inflation, and even interest rates. Now, we do reference some visuals in this episode that can be viewed on our YouTube channel by following the link below in this description. But even if you're just listening to this episode, you'll get the spirit of the discussion with or without the visual aids. Without further ado, let's jump right in. Another note that I jotted down while we're talking is, and this is while Matt was talking, is the discipline of following the rules. So we talk about this a lot, but creating this thing called an investment policy statement, and those are the guiding principles or the guardrails, if you will, of somebody's or a family's portfolio and what those rules around those investments should look like. And so then when you have those rules in place, it makes it really easy to execute the rebalances or the diversification that then needs to occur because we have those rules in place regardless of what's going on in the market and the economy. Now, I think that's a good shift when I talk about what's going on in the economy. Obviously, the markets have done well. We talked a little bit about that. I actually read a study recently that was pretty interesting, and it's the American Association of Individual Investors, and it's that 44.5% of them are feeling bullish going into 2025. It's the highest that's been since 2004 for that group of people that they polled. And so, I mean, obviously there's concerns going into 2025, right? I mean, valuations are at a high. And so I think I wanted to hear from you a little bit, and Matt, you as well, on just expectations for 2025 and what you guys think is coming ahead.
Sure. I mean, this is the greatest question in this industry, right? Is like, tell me what's going to happen in the next 12 months.
That's basically that's what I asked.
No pressure.
Are the markets going to be higher or lower in a year?
We are recording this, no pressure. And if you're wrong, it's just everyone's going to blast this out in cyberspace. You're good, Michael. Go for it. Good luck.
So exactly that, right? We can make an educated guess of what we think could happen based on the conditions today. Now, conditions can change on a dime. There are things that are going to occur this year that we don't have any idea about right now. But if we look at conditions today, I think our expectations have to be somewhere around mid to upper single digit returns. If we get something better than that, that's awesome. But I think we should prepare for mid to single digit returns. And the reason why I say that is, John, could you pull up our chart here on valuations?
Yeah.
Because we've mentioned this a couple times, is that our valuations they're not cheap. If anything, we're a little stretched. And this is a chart from JP Morgan. They do a great analysis of these charts. And this line that goes up and down in a real squiggly manner is a chart of the S&P 500 on a valuation basis. It's price over earnings of the index looking out over the next 12 months. And what you'll see right there is as of January 13th, 2025, we're trading at about a 21 times forward earnings. Now, if you're looking here, there are three dotted lines that come across. That middle one is the 30-year average, and you can see we're way above that. And then there's a statistical measure of what's considered one standard deviation away. And you'll see that we're above that as well. Historically speaking, you've got to go back to 2020, 2021 to see similar valuations. And then before that, you got to go back to the late 90s to the early 2000s on valuations like that. So when we think about this, we've had 2 years of 25% returns. If we get another year of 25% returns, one of two things is accurate. We've had amazing earnings growth, or we're in a bubble. So I don't think we're going to get amazing earnings growth, and we'll talk about that in just a second. But we should not get another 25% return, or we're going to be in trouble moving forward because we're going to be more of a bubble land. Our expectations should be more around mid-single digits. And that goes into a little bit of the next slide here, John. Can you roll down one? And I'm not going to go too deep into this because there's a lot of moving bars here, but I don't know if you can zoom in a little bit on the top right, John, but this looks at S&P 500 earnings growth. And when we think about what drives the market over time, it's earnings. It's how profitable are companies and how are they deriving value out of what they do. And there's two colors here, green and blue. And the green is what's being looked at as the Mag 7. So this is your Apple, your Microsoft, your Nvidia, your Googles, your Teslas, these big, massive AI tech companies in the S&P. And you'll see that their bars are much larger. We had a 50% growth in earnings in the first quarter of 2024, a year ago, and 35% in the second quarter. And you'll see that it begins to trend lower. And it stays relatively high, 18 to 20% on earnings growth is a huge number. However, the valuations of those companies are stretched today. We're seeing the Microsofts and the Apples trade above 30 times earnings. They are what's been pulling our market up over the past couple of years because that's where the earnings growth has been. So we need them to continue to do well to support those higher valuations. You can have higher valuations if you have the earnings growth. So when we think about what's going to happen in 2025, we're looking at it from a perspective of earnings. We think earnings moderates for those companies. And I say moderates because it's coming down from 50% to 20%, but 20% is still a good number. But what's really key is in the blue here, we see earnings begin to stabilize and grow for the other 490 some companies in the index. And that's really where we can see some growth. And that's really where we can see broadening out of the market and more of a healthy valuation adjustment in the market, where the overall market's valuation can come down because the other 490 stocks in the index see their earnings go up. And what we're looking for there, if you see, is 9, 8, 12, 16%. That averages for somewhere around 10% in 2025 in earnings growth. That's really kind of what we're thinking we're going to see in the market. And that's why we come to mid to high single digits. If we get lucky, maybe we see low teens. Now, the caveat here, and we'll go into in a little bit, is inflation and interest rates. What happens there? That can derail the train. And I know we may talk a little bit about tariffs and fiscal policy and different things. Those are all warning signs. Those are all potential things that could change this outlook. But when we think about what should happen in the market, the two things that I think we should remember is earnings growth is moderating in a healthy way. It's slowing down for the top ones and it's growing for the bottom ones. But also the valuations on the market is high at the moment. So we need a sustainable earnings growth to justify the valuation. And we should look for the market to move on earnings, not multiple growth.
Michael, it's funny you mentioned inflation because correct me if I'm wrong. I mean, I glanced at a couple articles in between meetings this morning, but it seemed like the markets, very fortuitous timing to do this today. It seemed like the markets were positively reacting to some
Job
inflation
is
data.
so easy, guys.
Yeah.
So easy. Market's up 600 points. Everything's fine.
But I think that's a good example of the volatility that can happen, good or bad, because obviously if you're saying like single digit returns for the year, I mean, long term historic returns for like the S&P are probably around 7%, depending on what time frame you're looking at. So it would just be more in line with the average of,
Mhm.
what you've seen long term. But we've grown so accustomed to over the last several years of big swings, negative market swings and positive. And so I think it's telling to see like an inflation report influencing the market that quickly. So when you say single digit returns for the year, that doesn't mean, unfortunately, that from January 15th to December 31st, it's this nice smooth trend line. As we all know, and everybody on this that's been an investor for a long time, the markets do a lot of zigging and zagging and they go up and down. So can we maybe is that a good time to transition to inflation and some of your viewpoints on things like what will the Fed do with interest rates? I
Sure.
mean, I've seen some reports saying they may not move at all, and I've seen other reports projecting one or two cuts, and so there's a lot within that. So maybe take that how you want to, but let's talk rates.
Sure. So I think it's key to remember that, and we just talked about in the long run, earnings is what drives the market, and that's what moves it in the long run. In the short run, the market changes its value based on a myriad of different inputs and variables. And what we've seen this morning with the market being up so much and really started yesterday and the day before a little bit um, was one of the inputs, inflation, for December is coming in less than is expected. And because inflation came in a little bit less than expected, interest rates began to come down a little bit. And we're not talking major numbers here, but they're ticking off a couple basis points here and there. And when we get into how the markets are valued using discounted cash flows and different things, a lower interest rate gives you a higher valuation on the market, which is why we see the market go up. Now, that's in the short run, right? Like we just put a new variable into the calculation. It's favorable, so we see a favorable change in the market. We're going to have to see for the rest of the year how earnings play out. And we had great numbers this morning from JP Morgan and some of the other banks as well. So, we're off to a strong start. However, we need that to continue to keep that trend in place. And I don't think I should add this to the expectation piece. I don't think we should be surprised if we see a 5 or 10% pullback before we
Hmm.
visit single digit returns. In some ways, that'd be healthy. It clears the deck of excesses and will allow ourselves to continue going. But when we talk about inflation and interest rates, and John, I'm going to ask you to pull this back up here because
Happy
it's
to.
it's it's key to when we look at what's going on with inflation. There's a chart here, perfect. This is a chart of inflation going back to January of 2018, and it decomposes CPI by its grouped inputs. So you can see basically in 2021 how inflation began to accelerate. And when we see that there, you'll see a couple things grow at faster rates than the others. The two first things is energy and core goods. So you'll see energy drops significantly in the spring of 2020, around that July 20 moment. And that's going to go back to the April, if you guys remember, where oil went negative for a week or so, or there was a couple days when it went negative. And you'll see that that was a lowering of inflation because people weren't buying gasoline. Well, fast forward to spring of 2021, suddenly we're out and about and doing things, and now we need more energy output. So you see energy is going up. And then we can add in the Russian-Ukraine war and different things that are going on, driving the cost of energy up. Well, the other piece to that, if you remember during COVID, is we all sat around our houses and we looked at how can we improve this? Or do we want to move? Those core goods, that's a lot of building materials. That's a lot of just different things that go into output. That's production materials. And oh, by the way, to move lumber from Florida to another state, or to move it from another state to Florida, yeah, truck that. And guess what the cost of shipping was doing at that time? You see those numbers explode. And then you can begin to see that's how shelter began to get more expensive. You remember, if you wanted to move
Mhm.
your house, you had to buy a new house, the housing market took off. Home prices went up. the cost of renovating and everything changes. And I know we all felt that in different ways. And then you begin to get in the services, and you really saw that inflation permeate throughout the economy. Now, when you fast forward into 23, 24, and now into 25, you'll see that that energy and that core goods is coming down a lot. Um, the the food at home is not going up as much. The cost of buying our food is changing. What's really left here? Well, there's still of inflation in services. Auto insurance is up a bit. And if we think about it, I don't know if you guys have bought a car pre-COVID to post-COVID, the cost of vehicles have gone up. So it stands to consider if you're going to buy the same vehicle with it and those two different windows, it's going to cost more to insure it because it costs more to buy it. It has a higher value. So we're really seeing that happen. And then you'll see the bottom piece, this is the stickiest piece, is shelter. And this is sticky for a couple of reasons. One, the cost of building homes has gone up, but shelter is composed of two pieces. One piece is called owner's equivalent rent. The other piece is actual rents. Owner's equivalent rent is if John calls me and says, hey, Michael, if you were to rent your house out this month, how much do you think you could get for it? It's not actually a real number. It's not what we're paying. Like my mortgage is much different than what I could rent my house out for. So that number gets a little bit more sticky. And because leases are oftentimes on a 12-month time frame, it takes time for those to update. But we're beginning to see those pieces come down, which is why you're seeing the inflation numbers begin to moderate, and they're continuing to come lower. The number we saw this morning was actually 2.9%. So it's a tick higher than it was in November, but there was actually an increase in gas prices that pushed that number up substantially in December because the month of January has been so cold. So the increase of energy. When we actually look at core, which is the shelter and the other pieces there, that piece actually came in under, which is a very positive sign, which is why the markets have responded so well today.
Michael, I'm sorry, keep going. I mean to interrupt you. I want to ask you a question on this conversation, but it's kind of a difficult one. So it's about tariffs, which I mean, like, I think we're hearing about this more. I mean, I've read some proposals that are suggesting 10% tariffs on all imports, 60% tariffs on Chinese imports. So I guess my question, like logically, if that happens, that's going to create an environment where there's higher inflation on those goods that we're importing. How do you see this impacting inflation, like in your crystal ball of things? How do you see it impacting inflation and or I guess the Fed's decision on rates?
The difficult piece with tariffs is that if you look at tariffs in a vacuum, they are destructive to an economy, right? However, the reality that we saw in the first Trump presidency is that we would throw a tariff on a country and then we would carve out a whole bunch of stuff. And the tariffs that were levied were not the tariffs that were discussed necessarily. So we're talking about levying tariffs across countries, but then we're going to carve out milk from Canada and different things. And I'm not being a proponent of tariffs by any stretch of the imagination, but I think the better way of thinking about it is if you're driving down the highway and you need to get off at an exit because it's time to get off for whatever reason. If you wait to the last second to get off and then there's a backup on the exit and you slam your brakes, you feel it, right? But if you start moving over and you begin to slow down, put your blinker on, and you slowly change your rate of speed, and maybe there isn't a backup at the exit, you don't feel the car slowing down as much as you would as if you just slammed on the brakes at one point in time. And I'm not prognosticating on how tariffs are going to be levied this year, but if they're levied in a sensible way where we see them coming and we know what's happening, they may not have a huge effect on inflation because that's kind of what happened in the first Trump presidency, and we didn't average 2% the entire time of inflation. However, if we throw blanket tariffs across the board on countries, we are going to slam on the brakes and we are going to feel it. So it is a very I feel like I don't want to make that a escaped answer, but it's a very nuanced approach to it, and we should see what happens. I would expect Trump does not want to he doesn't want to ruin the economy because he's the business president. That's who he is. He's a businessman. Um, he doesn't want to be remembered for throwing the country into a recession. I would err on the side that it's going to be more nuanced than 100% tariffs on different countries.
That makes sense. I mean, and again, I think people are just hearing about this in the news and the media and different articles. And so I wanted to ask you because I think that's a really good objective viewpoint of what you think might happen, which frankly, we don't know what that's going to look like yet. Talking about just in general, some of the tax policy changes that are upcoming. I know there's a handful on our list that we wanted to chat through. Matt and or Michael, is there one that you guys want to make sure we focus on? I would say we probably have like 10 to 12 minutes left in our conversation, just trying to keep it at 45 minutes. Is there one or two that you guys really wanted to make sure we chatted with everybody today about?
Yeah, I mean, I think that there was four main changes that occurred in 2017, and those four main kind of changes are set to expire at the end of 2025. Now, again, this is sort of just, it's interesting the way it worked is the president who enacted all of those laws in 2017 was not president for the last 4 years and is now back in power again.
It's a good point.
Really interested to see how this goes. And I know interested is a very loose word for most people on this call who are not reading up on tax law daily as I do, and really like kind of fascinated with how all these pieces work together. But those four main things, those four main areas that are set to expire. First is the individual tax rate itself. Was reduced in 2017 and stayed at a reduced rate and again set to expire. So that's the first one. The second one is a standard deduction. Everyone basically received double the standard deduction that they had prior to 2017. And this caused a lot of people to not need to itemize their taxes, even if they had a little bit of donations, some home interest, some real estate taxes. It wasn't enough to trigger itemization. So it really did help those that typically were not itemizing. They got this huge bump in deductions. The next was a child tax credit, not really impacting a ton of our clients because we're mostly dealing with the pre-retirees and retirees, but it was a more than doubling of the child tax credit, which again, helping those maybe on the other end of the economic spectrum. And then last but not least, number four, sort of a catch-all of other deductions and exemptions. The biggest one being is the reduction of the corporate tax rate from 35% to 21%. And I know for Candor Path, if I can speak on behalf of a business owner, is that reduction in our overall tax allowed us to ramp up hiring, to put more money into our business, to be able to serve our clients in a better spot. So for selfish reasons, looking at that corporate tax rate, would love to see that kind of not go back to 35%, stay at the 21%, allow us to reinvest. We're a small to medium-sized business, reinvest those dollars right back into our business itself. The biggest one that I'm hearing a lot, and it sort of goes back to the tariff question, is like we're hearing these bits and pieces, but we have a lot of clients who are on Social Security, right? It's a supplement to their portfolio, supplement to their income. And the question that was, or the comment that was floated during the debates and kind of during the time prior to President Trump getting reelected was he, as part of a broad reach of additional tax measures, was saying, hey, we're not going to tax Social Security, or at least floating that out there as an idea. And I get to ask that a lot on our meetings. It's a much longer discussion on how Social Security actually gets taxed. Thankfully, it's massively complex. And that's what basically keeps me employed, is having these really complex rules.
I was like, what do you mean, thankfully? Oh,
yeah, thankfully. Because if it's easy, if we're down to flat tax, I mean,
everyone's doing a 1040 easy.
You have no reason to have me in your life. But if it's complex, I need to be there to help you and guide that. So one of the areas, which John, can you bring up the federal deficit slide?
Yeah, I gotcha. While I'm pulling it up, for those that might not know on this call, because there's a few new faces I see here. Matt is an enrolled agent with the IRS and our resident tax expert. Hence,
I'm not armed. They didn't arm me when I enrolled. None of the remember it was asked that one time in a meeting.
Yeah.
John, the guy.
Yeah. Are you carrying? Yeah.
Yeah. Do not carry. So on this here, we're not going to go into federal deficit and have your eyes glaze over. But take a look. John, if you could just scroll in on the left side there of that screen.
I got you, buddy.
So on the left side, think of this as your household income, right? You're currently spending right now, and let's just take some of these zeros away. You're spending $70,000 a year, is what your bills are, your mortgage, and all of those good things are. But over on the right-hand side of that, you're only bringing in, let's see, $50,000 a year, right? So you're spending 70, you make 50 at your job. How is that even possible? What are you doing? You're borrowing.
Not good financial stewardship right there.
Not the best. Yeah, that's not the best. So this boxed in area that's got the dashed lines is what we're using to borrow to make our 70. So the question, and then look at what that 70 is made up of. You have interest, that gray down there is interest on bonds. So the interest that we're paying. You have the big green one. We'll come back to that one here in a second. You have Medicare in blue, Medicaid in light blue, other mandatory pieces, keeping, parks and recreations open, all of these other things. We have defense to defend our country and non-defense discretionary spending. So going back to the big green one, it's actually the largest piece of spending that the United States government has. Well, this is mostly derived through our payroll tax. And our payroll tax is what pays for a portion of this. But in addition to that, we still have federal income tax. And so for those that ask me the question, Matt, will they stop including our Social Security as part of our taxable income? I have a hard time looking someone in the eye and saying, yeah, like we have more room to reduce tax. If anything, I mean, taxes need to at least increase, or spending needs to come down. But I can't imagine any politician running on a platform which will cut any one of these, especially the two biggest, which is our Medicare and our Social Security, which is our baby boomers, our greatest generation. Those are our largest. That's our largest pool of people in the United States. They are going to vote, and oftentimes with their wallet, and say, like, yeah, you can do anything you want, just don't stop my Social Security or mess with it too much. So we don't know where this is going to land. I'm watching it very, very closely, but really interesting on those 4 points of where we end up going. And on some of these like theoretical ideas is how do those actually get implemented? I see payroll tax having to rise if we're going to, and that's sort of more of an offset. The payers into Social Security will be paying a proportionally higher amount, and those that are receiving Social Security might get that as tax-free. Don't know where that's going to go, but my job is not to know where it's going to go. It's to navigate it once I get the rules on what needs to happen, and then we navigate it from there.
That's a good answer. I'm curious, and Michael, I want to open this up to you too. Like, how worried should we be about this? Because this is obviously this is a telling graphic, and it's not a good one. And I think a lot of what I'm hearing about is tax cuts. So, like, obviously, that's great in the short run. It stimulates the economy, but it leads to a larger deficit. So, I'm assuming there's offsets that will be there, kind of a little bit of what Matt talked about. Like, how worried should we be about this? Really, I love asking these. I love asking these nebulous questions and then seeing Michael's face while he's watching me ask.
The short answer is more worried than we should be yesterday. Every day we get closer to a potential catalyst of a problem. Realistically, we're not in a hurt yet, but the trajectory that we're on is not sustainable. And I think that's really what we have to come to terms with. And like Matt said, and John, I don't know if you can pull it right back up real quick.
Yeah, sure. No worries.
It's a little easy to talk through it this way. When we look at that budget, you have to remember that everything on the left in spending is tied to somebody somewhere in some district. Whether it's defense, Medicare, Medicaid, non-defense discretionary, everything is tied somewhere. So when you pull a dollar back, you're upsetting someone in some situation. So and that's in someone in Congress's district as well. So you have to keep that in mind. The other piece that we have to keep in mind is that Medicare and Social Security is paid for by the payroll taxes. You'll see that, there's 1.7 trillion that comes in, and we're paying out 2.7 trillion. The math doesn't math right there, at some point we're going to have to come to terms with payroll taxes going up, and I think that's a starting point for this country to discuss, um, how do you tax the wealthy without taxing everybody. And payroll taxes seems to be an area that we haven't gone to yet, but
Yeah.
um, you think about payroll taxes are capped at a certain number. So you get above, and the number changes every year. It's indexed to inflation. It's somewhere between 140 and 150,000 in 2024. Above that number, you stop paying payroll taxes. Um, at that point, that money that you get paid on your W-2 or your bonuses don't get taxed anymore. So for the federal government to come in and supply Medicare and Social Security with more revenue, that's an area where you're only going to be taxing people making above $150,000. We'll call it as an estimate there,
Right.
and it doesn't affect anyone earning $30,000 to $40,000. So, and businesses pay the other half of that too. So it's a tax on businesses and it's a tax on high wage earners. I think that's probably some low hanging fruit that probably needs to be addressed at some point. The other piece is we should be prepared for our upper tax brackets at some point. On personal rates are probably going to have to go up if we're having an honest conversation down the line. Is that today? No, but 2030 seems to be a time frame where things begin to look a lot more shaky, and where some changes are going to have to come into place. Corporate taxes, could they get increased again? Sure. There's a lot of nuances to the corporate tax code. Most corporations in the U.S., Matt, correct me if I'm wrong on this, operate as S corps, so they get taxed on a personal level, not a corporate level.
Yeah.
So that's another thing that's a little interesting, because you
And
avoid
that
the
goes to
double
one of the
taxation.
questions that was just asked. Yeah, it's not a true picture of looking at the corporate tax and saying that number should go up. Canada Path, again, for instance, we're a partnership, passes through, it passes through to personal income. And I would say a majority of small to medium-sized businesses are that. You do have the large conglomerates, which again, completely different tax structure there. But the offset of the additional taxes that we're paying, such as 1/2 of the payroll tax, is coming out of that side of the equation. And again, there's the jobs number that we look at too, is where is the hiring taking place, and that takes money for that to happen, and then that is a pass through down to the population. So hard one to answer on that. I always find it tough though when we're talking in billions. Take a couple zeros away and talk it in our terms. 70,000's going out and 50,000's coming in. How do we close that gap? And you even saw in there were tariffs. That would be about $7,000 of the the difference that we have there. So still not enough to make up that massive difference.
Well said. Well, I mean, we unpacked a lot today, guys. I mean, between inflation and rates and broaching things like the deficit and tariffs, expectations for the market this year, single-digit market returns. Any parting words of wisdom that you would like to leave everyone hanging with us today?
Yeah, if you love this, well, you're in luck, because John's going to talk about, we got a few more of these coming up. We're going to do these once a quarter, and again, the point of these quarterly updates are actually just meant to be what is it we discuss on our Friday meetings? How are we shaping the policy of your portfolio? Because we touch every portfolio every single Friday, discuss them all. What happened? What do we need to do? What changes need to take place? So this is sort of an insight to that. But I really want to promote something that John has put a lot of his heart and soul into, which is our e-course. It is our free e-course. You have that, maybe it's just entering the workforce person, or someone who's looking to get their financial life in order. They're not quite ready to meet with us to talk about, the nitty and gritty, but they need an understanding of the e-course. We're going to drop a link here in the chat for the e-course. Check it out. Pass it along to friends and family. It's a video-based course, so it's not just, you're not just typing or reading on a screen. It's John actually putting a series of videos together and going through the ins and outs of basic finance. And once that's done, then you're ready to meet with someone. We're here for those people. But it's great for our referrals to check that out first and get their budget in order, get their 401ks in order. And then once they get to us, we can then fine tune that. So first is that. The second is we run a podcast, which is the Above Board podcast. We talk about personal finance. We talk about personal development, a whole series of things. So if you can't get enough of us, there's plenty of resources out there for you to hear more about what we talk about and get to know us a little bit better. And again, I'm looking at the list, the names on our list here for today's attendees. You hear us talk a lot, so maybe it's not for you, but for those friends and family that you're trying to get us in front of, those are two great resources to pass along to everybody.